Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at energy fuels.
If you find our talks useful, please consider subscribe, like, and comment underneath. Moving straight into the analysis, Wall Street is highly fixated on energy fuels right now.
Extremely fixated. I mean, we are looking at a stock boasting a 7.5 out of 10 bullish score.
And a consensus strong buy rating across the board.
Right.
The market action here has been, well, it's been nothing short of explosive. You're looking at a staggering 367.6% run over the last 12 months.
Which is a massive move.
Massive. But the stock recently took a noticeable tactical pullback.
Yeah, it cooled off a bit.
Exactly. So the core question we need to resolve today for anyone managing a wealth-building portfolio is whether this recent dip represents a high-probability entry point.
Or if there are structural hidden risks that the broader market is just beginning to price in.
Right. We are going to break down their fundamental metrics, evaluate this competitive moat they have, which is practically unmatched in North America.
Truly unmatched.
Scrutinize the technical price action, and map out the critical catalysts hitting in the next 3 months.
Let's start by unpacking those top-line fundamentals, because the recent revenue numbers really do command attention.
They do. For the full year of 2025, Energy Fuels delivered $48 million in revenue.
Right, and they achieved this primarily by selling 650,000 pounds of uranium.
At a weighted average realized price of $74.21 per pound.
Exactly. But the fourth quarter specifically is what caught my eye.
Oh, the Q4 beat.
Yes.
Yeah.
They posted $27.1 million in quarterly sales.
Against a Wall Street estimate of just $21.8 million.
Right. A beat of that magnitude is significant.
It is, but I have to play devil's advocate here.
Go for it.
Before we celebrate the top-line momentum, the bottom line is flashing bright red.
It is.
We are looking at a negative 129.9% net margin.
Yeah.
And a negative 81.6% operating margin. That isn't just a slight cash burn, that is a massive structural deficit.
It sounds alarming.
It really does.
Yeah.
How does a company with margins that deep in the red command a unanimous strong buy from institutional analysts?
Well, it comes down to how institutional capital models transition phases versus, current snapshots.
Okay, explain it for us.
If you evaluate energy fuels purely as a mature, steady-state business, those negative margins are terrifying.
Right.
But that is not what this company is right now. They are actively engaged in incredibly heavy capital-intensive build-outs.
The expansion projects.
Exactly. They are aggressively scaling production at the White Mesa Mill and, at the same time, expanding their complex rare earth processing capabilities.
And that infrastructure isn't cheap.
Not at all. The upfront capital expenditure required for that scale of industrial infrastructure is immense, and it heavily suppresses current profit margins.
So analysts are looking past the current quarter?
They are modeling out the operational trajectory. If you look closely at that same fourth quarter of 2025...
The one they beat on revenue.
Right. Their earnings per share loss actually improved by 52.6%.
That's a solid jump.
They moved from a 19-cent loss down to a 9-cent loss. The bleeding is slowing down dramatically as their production scales.
Okay, a tightening of the per share loss is definitely a positive indicator, but they are still inherently unprofitable today.
True.
And management's 2026 guidance projects that revenue will nearly double over the next 12 months.
Which is aggressive.
Very. I understand the mechanics of operating leverage, where your fixed costs are absorbed across a much larger revenue base. But that entire thesis relies on flawless execution.
It absolutely does.
They are essentially spending heavily now with the promise of future efficiency. And that brings me to their balance sheet.
Let's look at the liquidity.
Right. To fund a capital deficit of this size, you need immense liquidity. They're currently sitting on $64.7 million in cash reserves.
And look at their current ratio.
It's 30.7x.
Which is incredible.
But I have to challenge that capital allocation strategy.
How so?
Sitting on a 30.7x current ratio means they have over $30 in liquid assets for every single dollar of short-term debt. From an efficiency standpoint, isn't that just hoarding cash? Why aren't they deploying that capital much more aggressively to accelerate these rare earth build-outs and, cross that profitability threshold sooner?
It might look like inefficient capital allocation if you are analyzing a software company.
Right.
But in the critical minerals processing sector, extreme liquidity is a vital survival mechanism.
because of the environment they operate in.
Exactly. This is an industry notorious for sudden regulatory delays, severe supply chain bottlenecks for highly specialized mining equipment, and just aggressive commodity price volatility.
So the cash is a buffer.
A massive buffer. By maintaining a fortress balance sheet with that 30.7x current ratio, management is completely insulating the company from short-term debt crunches.
Or the need to secure high-interest loans in a restrictive macro environment.
Precisely. More importantly, it means they can fund the White Mesa Mill expansions internally. They don't need to dilute their current shareholders through secondary stock offerings at current valuations.
Which investors love.
Oh, the institutional market is actually rewarding this conservative fiscal management. We see that reflected directly in their net asset value multiple.
The NAV multiple.
Yeah, it recently expanded from 1.7 to 2.0x.
That NAV multiple expansion is a crucial data point. Moving from a 1.7x to a 2.0x multiple indicates that the market is assigning a significantly higher premium to their physical assets.
Exactly.
And typically, you only see that kind of multiple expansion when management effectively de-risks a major project and proves operational viability.
Which they are doing.
Is that premium entirely anchored to the White Mesa Mill?
Almost entirely. The White Mesa Mill is the absolute core of the institutional bullish thesis.
Let's talk about that.
It is the only fully integrated uranium, rare earth, and vanadium processing facility currently operating in the United States.
Let's break down the mechanics of why that matters, because fully integrated is a term thrown around a lot in corporate presentations.
It's a buzzword.
Yeah, a buzzword. Having the only operating facility in the U.S. sounds like a great talking point. But how does that translate into tangible, high switching costs for their commercial customers?
Well, think about the immense complexity of the alternative.
Okay.
If a customer, say, a major defense contractor building advanced guidance systems.
Or a clean energy manufacturer building wind turbines.
Right. If they need processed rare earth elements and uranium, their traditional alternative involves navigating a highly fractured global supply chain.
Which is a nightmare right now.
Historically, they would have to source raw materials from Africa or South America, ship them to China for complex chemical processing, and then navigate a volatile web of export tariffs, geopolitical friction, and shipping delays just to get the finished material back to North America.
So Energy Fuels solves that entirely.
Energy Fuels offers a localized, closed-loop domestic source. Once a manufacturer integrates their long-term material procurement with the White Mesa facility, the logistical, regulatory, and financial friction of switching back to a multi-continent supply chain is prohibitively high.
It is essentially the TSMC of critical minerals for North America.
That's a great comparison.
A localized bottleneck that every major industrial player is eventually going to be forced to use.
Yeah.
But building another processing facility isn't illegal.
No, it's not.
If the future margins for domestic processing are projected to be this lucrative, what is stopping a well-funded competitor like a massive multinational mining conglomerate from raising $2 billion and simply building a rival integrated mill in Nevada or Wyoming?
The barrier to entry in this specific sector isn't just access to capital.
What is it?
It is the regulatory and environmental permitting labyrinth.
Ah, the red tape.
Permitting a greenfield facility that handles radioactive materials like uranium alongside the highly toxic chemical extraction required for rare earths and vanadium, that is a process that takes decades in the United States.
Decades.
You have to clear the Nuclear Regulatory Commission, the EPA, state-level environmental boards, and local community pushback.
And White Mesa is already clear.
White Mesa already exists and holds the active licenses. They have a multi-decade regulatory head start. The bureaucratic moat is arguably much deeper than the financial moat.
That's fascinating.
Combine that regulatory monopoly with current geopolitical tailwinds. U.S. policy is undergoing a massive structural shift to aggressively incentivize domestic supply chains.
The cheap S-Act style push, but for minerals.
Exactly. The clear objective is to reduce reliance on China and other adversarial nations for materials that are absolutely critical to national security and next-generation energy infrastructure.
And Energy Fuels is perfectly positioned to capture those government incentives.
Perfectly positioned.
So we have a company with a regulatory monopoly, immense liquidity, and massive geopolitical tailwinds driving their long-term narrative.
Which is a very strong setup.
It is. That fundamental backdrop easily explains the 367.6% run over the last 12 months. But if we pivot to the technical price action and market sentiment, the chart tells a slightly more nuanced story right now.
It does.
The stock is up 30.9% year to date. But we've seen a noticeable pullback recently.
The tactical dip?
Yeah. It shed about 10% over the last month, settling right around the $19.03 mark.
Right.
From a strict wealth-building perspective, when a momentum stock drops 10% in a month, you have to critically evaluate whether the underlying narrative is cracking or if this is just standard market rotation.
The chart strongly points to healthy consolidation rather than a trend reversal.
Walk us through that.
At $19.03, the stock is sitting roughly 31.8% below its 52-week high of $27.90.
Okay.
When an equity runs up nearly 400% in a single year, institutional profit-taking is inevitable. No stock moves in a straight vertical line forever.
Of course not.
The key technical indicator here is that the pullback stopped and stabilized around the $19 level.
Which creates a floor.
Yes, creating what technicians call a higher low structure. Instead of mean reverting all the way back down to the single digits where it started a year ago, it has established a robust new floor.
So it's catching its breath.
This is a classic consolidation phase. The stock is absorbing the massive recent gains and building a technical base for a potential next leg up.
And the Wall Street targets certainly support the theory of an impending move higher.
They really do.
The consensus median price target right now is sitting at $27.25.
Which is huge.
From the current $19.03 level, that implies a massive 43.2% upside just to reach the median expectation.
Just the median.
Right. And these aren't stale targets from 6 months ago before the pullback. H.C. Wainwright actively maintained their buy rating on February 27, 2026, and actually pushed their price target up to that $27.25 mark.
They doubled down.
What I find highly unusual, however, is the absolute lack of dissenting opinions among analysts.
It's rare.
Out of the Wall Street analysts covering the stock, we have an overall sentiment score of 9.3 out of 10. There are 7 buys, 1 hold, and 0 sells.
Not a single sell. Not a single institutional desk thinks this stock is going to underperform the broader market. If the smart money is this unanimously convicted, why hasn't the broader retail market bid the stock up to price in that 2026 revenue doubling?
That gap highlights a massive divergence between retail investor psychology and institutional modeling.
How so?
The broader retail market often relies on stock screeners that filter for current profitability, dividend yields, or traditional price-to-earnings ratios.
Right, the standard metrics.
When retail investors see a negative 129% net margin, many simply walk away.
They don't look under the hood.
Exactly. Institutional capital, however, is looking 6 to 12 months down the road. They are mathematically modeling the operational leverage that will trigger once the White Mesa expansions are fully online, and those fixed costs are absorbed by double the revenue.
So the opportunity gap exists simply because the broader market hasn't fully digested the financial impact of the upcoming production scale-up.
That's exactly it. That timeline is crucial. If institutional money is looking 6 to 12 months out, investors need to know exactly what events are on the calendar that will force the broader market to finally reprice this stock.
The catalyst path.
Right, and the upcoming 3 months are exceptionally dense with potential catalysts.
Very dense.
Let's start with the leadership transition. On April 15th, 2026, Ross Papu officially takes over as president and CEO.
A major move.
This isn't just a standard corporate reshuffling. What does Papu's specific background signal to the market regarding the company's immediate priorities?
It signals a hard, deliberate pivot from asset accumulation to ruthless operational execution.
Ruthless execution.
The previous leadership successfully navigated the company through the strategic phase. They secured the vital assets, strengthened the balance sheet, and outlined the fully integrated facility strategy.
They laid the foundation.
Yes. Papu, however, brings a deep, hands-on operational mining and metallurgy pedigree to the table.
He's a technical guy.
Very much so. When a company is publicly tasked with doubling its revenue in a single year, while simultaneously scaling incredibly complex rare earth and uranium processing circuits, you cannot afford a theoretical visionary at the helm.
You need a strict operator.
Exactly. His mandate is execution. His appointment signals to institutional investors that management is entirely focused on ensuring these massive capital projects come online on time and strictly on budget.
The timing of his arrival aligned perfectly with their Q1 2026 earnings release, which is expected in early April.
That's going to be a major event.
That Q1 report is going to be the ultimate proving ground. The Q4 beat of $27.1 million was impressive, but to justify a $27 price target, they have to prove that the Q4 operational momentum wasn't a seasonal anomaly.
Right.
The market will be heavily scrutinizing their forward guidance to ensure that ambitious 2026 revenue doubling is still mathematically on track.
And the Q1 earnings call will likely be Bapu's first major interaction with institutional analysts in his new capacity.
Setting the tone.
If he can confidently reiterate the 2026 revenue guidance and provide concrete, de-risk progress updates on the White Mesa physical expansion, that $19 consolidation base will likely serve as the launchpad toward those $27 analyst targets.
Beyond earnings and leadership changes, there is also an undercurrent of speculative M&A chatter surrounding the company.
Which is really interesting right now.
We know the U.S. government is aggressively pushing capital and tax incentives into domestic supply chains. Given the irreplaceable, fully licensed nature of the White Mesa Mill, how highly should investors weigh the probability of strategic partnerships or outright acquisitions?
It absolutely has to be factored in as a highly credible, albeit speculative, upside catalyst.
Okay.
You have major aerospace defense contractors and massive global energy conglomerates who are suddenly hyper-aware of their severe supply chain vulnerabilities.
They're exposed.
Mathematically exposed. They
Right.
require guaranteed, uninterrupted access to these critical minerals to fulfill their own government contracts.
Right.
Partnering with, or even taking a strategic equity stake in, Energy Fuels is the most efficient way for a major industrial player to secure a private, localized supply chain.
By the supplier.
Exactly. While we haven't seen any formal announcements yet, the overarching macro environment makes strategic joint ventures or partnerships highly logical over the next 12 to 18 months.
We have laid out a very compelling, data-driven, bullish framework. But I want to aggressively stress test this thesis.
Let's do it.
No equity operates in a vacuum, and a projected 43.2% upside implies a significant amount of assumed risk.
Always.
Let's tackle the macro headwinds first. Over the last few weeks, we've seen uranium and nuclear-adjacent shares trade noticeably lower across the sector.
We have.
A significant driver of this has been broader market volatility and escalating geopolitical tensions in the Middle East, which historically injects chaos and risk-off behavior into the global energy markets.
Yes.
With the spot price of uranium currently hovering around $74 per pound, how vulnerable is Energy Fuels if we see a sustained macroeconomic collapse in spot prices?
It is a highly valid concern and a core risk factor. Because their current profit margins are heavily pressured by massive capital expenditures, a significant, sustained drop in realized uranium pricing would severely compress their incoming cash flow,
Pushing back their profitability timeline.
pushing back their timeline for crossing over into positive earnings. However, they are not entirely exposed to the whims of the daily spot market.
They have hedges in place.
The company has strategically locked in long-term supply contracts with major utility buyers, establishing a blended realized price that smooths out short-term commodity volatility.
That makes sense.
Furthermore, the overarching U.S. policy support for domestic critical minerals effectively acts as a soft price floor.
So they won't let it fail.
The strategic reality is that the U.S. government cannot afford to let its only fully integrated domestic processor fail due to short-term cyclical commodity fluctuations.
I'll concede that the long-term contracts provide a layer of armor against macro pricing volatility.
But
But the internal risks are arguably much more severe.
the execution piece.
Yes. The entire institutional bull case, the unanimous strong buy ratings, the expanding NAV multiple, the aggressive $27 price targets, hinges entirely on pristine internal execution.
Flawless execution.
They have to successfully double their revenue in 2026. Scaling these types of chemical processing facilities is notoriously plagued by engineering bottlenecks and labor shortages.
It's incredibly complex work.
What happens if they announce a massive capital cost overrun or a 6-month delay on the rare earth extraction circuit during that Q1 earnings call?
If that happens, the premium the market has assigned them will evaporate instantly.
Just gone.
The institutional capital that is currently willing to look past the negative 129% net margin is doing so under the strict assumption of operational competence.
Right.
Any technical snag in the rare earth processing scale-up or any significant supply chain delay in the White Mesa build-out would trigger a harsh and immediate repricing of the stock.
So the floor drops out.
The equity would likely break entirely below that $19 technical support level, as analysts are forced to revise their 2026 revenue models significantly downward.
So execution is everything.
The execution risk is the single largest variable in this entire investment thesis. The market is paying for future perfection based on current momentum.
That perfectly frames the parameters of the opportunity. Let's synthesize all of this data into an actionable strategy.
Sure.
For an investor analyzing their wealth-building portfolio, Energy Fuels presents a highly specific 6 to 12-month swing trade setup.
A very clear timeline.
On one side of the ledger, you have a company operating a literal regulatory monopoly in the U.S. for fully integrated uranium, rare earth, and vanadium processing, backed by massive geopolitical tailwinds.
And they have a fortress balance sheet with a 30.7x current ratio, fully capable of funding their infrastructure expansions without immediate shareholder dilution.
And on the other side of the ledger, you have a stock that has pulled back 31.8% from its recent highs.
Establishing a strong technical base around the $19.03 level.
Exactly.
Yeah.
Entering the stock at this consolidation level ahead of the April 15th CEO transition and the critical Q1 earnings report offers a highly favorable risk-to-reward ratio.
As long as the company executes on their 2026 guidance without engineering delays, you are looking at a high probability push toward the $27.25 median Wall Street target.
Which represents a 30 to 40% return profile.
It's a very compelling setup.
The timeline is the critical factor here. Investors need to monitor those early April catalysts closely to confirm that the execution narrative remains perfectly intact.
Watch that Q1 call.
To wrap up today's analysis, I want to pose a broader, provocative question regarding the endgame of this entire geopolitical shift.
Let's hear it.
We've established that the White Mesa Mill is the only fully licensed facility of its kind in the United States.
Right.
If Energy Fuels successfully proves over the next 12 months that a fully integrated domestic critical minerals facility can scale to massive profitability without relying on overseas processing networks, it forces us to rethink the entire sector landscape.
It changes the paradigm entirely.
Could this specific success trigger a massive wave of corporate consolidation?
M&A across the board.
Major defense contractors and multi-billion-dollar energy conglomerates are currently terrified of international supply chain disruptions.
They are highly exposed.
If Energy Fuels proves the domestic processing model is financially and technically viable, how long before those corporate giants decide to simply acquire domestic miners and processors outright?
Just buy them up to completely privatize and secure their own material supply chains.
Exactly. It is a fascinating dynamic to consider as this geopolitical chess match accelerates over the coming decade.
It really is something to keep an eye on.
Keep questioning the market narratives, stay analytical about the mechanics driving your portfolio, and we will catch you on the next one.